All right, everyone, we need to talk. The market could get a lot worse. The last time the stock market got scared because of interest rate hikes, the S&P 500 fell around 20% in 2018. Today, the S&P 500 has barely fallen and many stocks are already tanking. I think I've made a bit of an oversight here and I really want to address this. Sometimes I forget that a lot of you watching this are fairly new to the channel and that you may have not watched a bunch of my older videos. And because I felt like I didn't want to be constantly repeating myself, I haven't mentioned some of the main points from those videos as much recently. But I think we should talk about them again now because we may be entering into a time when that information is as important as it's ever been. So in today's video, I'm going to tell you 4 things that you need to know if the market does get worse. Of course, I don't have a crystal ball. It might not get worse. And if that's the case, hey, that is great. But if it does get worse, at least you'll be prepared. First of all, I want to make it crystal clear, especially to the newer people watching this, that my main approach to investing is passive index ETF investing. Based on the data, this is the best and most reliable way to invest your money for the long term, and that's why the majority of my money goes into these things. But recently, I've made videos discussing my investments into things like Tesla and crypto, which seems to run counter to my main investment strategy. So my goal today is to explain how both of those things coexist for me and to give you 4 points for navigating a real market crash. Anytime I make an investment into something, it's because I have conviction in that thing. But what does conviction mean? For me, I define conviction as the strength of my confidence in a particular investment. But where does this conviction come from? For a lot of new investors, their conviction on something comes from one of 2 places. Either somebody told them about a particular investment, or they see that the price is going up. Look, if this is you, and you're feeling called out right now, don't feel too guilty about it. Everyone has been there. I certainly have. But there is a huge problem here. Can you guess what that problem is? Well, let's think about it. If your conviction in something, meaning your confidence in something, is because you saw the price going up, what happens when the price is going down? Well, I'll show you what happens. Leading up to December 2020, ARK Invest's main ETF was up 130% for the year. That's amazing. So what did investors do? Well, they all jumped on board. They flooded into the ETF. And by the end of that year, ARK's main ETF had the 4th highest inflows out of any ETF. That is insane. Just a few spots below the absolute King Kong of ETFs, Vanguard. But what happened after December 2020? Well, ARK continued to go up a little bit, but then for the rest of 2021, they fell about 40%. And what did investors do now? Well, they held, of course, because their conviction in this ETF was so strong, and it surely was not at all just based on the number going up. Unfortunately, that was not the case. When ARK's ETF fell, investors pulled their money out of the ETF at record numbers. This was an absolute classic buy high, sell low scenario. This is what happens when your conviction on an investment is based solely on the price going up. This is not a good way to build an investment thesis. So that begs the question, where should our conviction in something come from then? Personally, I believe in heavily researching something to either confirm or deny my conviction. Based on my research, index ETFs are the undisputed king of long-term reliable investing, and I've talked a lot about this in my previous videos. But for those of you who are new to the channel and you don't want to go back to older videos, just leave me a comment down below if you'd like me to make some new content about these ETFs. Next to that, what about individual stocks? Well, I think you've got some work to do, my friend. Let me show you. Now, what you're looking at here is a relatively simple way to kind of quickly value a stock. So let's run through this together using Tesla as an example. So first of all, this is a 10-year model. All the numbers in here are based on a 10-year projection. So at the end, we'll get a 10-year stock price. So 10 years into the future. So to start, let's input their current revenue here. Now, there's a few ways you can calculate this for the purposes of this model. For simplicity's sake, I'm going to take the rough figure of their last quarter's revenue and just multiply that by 4. To find this, simply type in the company's name that you want to search, followed by the most recent quarter. So right now, this is 3Q 2021, third quarter of 2021. Then you can look for the company's shareholder letter for that quarter. Once you find that, you can look for the revenue. So Tesla shows $13.757 billion here for this particular quarter. So I'm just going to take 13 billion and multiply it by 4 to give us $52 billion in annual revenue based on the company's current position. Next, we need to assign a growth rate to this revenue. Now, this is much more of an art than a science, as this will drastically impact the rest of this valuation. So it's important to really play around with this figure to see what different growth rates do, because if you input a really high growth rate, well, it's going to make your investment look great. Whereas if you input a low growth rate, it might make it look like crap. And estimating growth is pretty hard to do accurately. So with that being said, I'm going to put 40% in here. And before you start yelling at me that this is a very high growth rate, yes, I realize that. I realize this is a very high growth rate, but Tesla's own stated goal is to grow at 50% over this period of time. It's super aggressive. I can't stress this enough. That's so aggressive to try and do that. And if they do not achieve this, the valuation of Tesla falls apart. And that's, I think, part of the reason why Tesla especially gets hammered when stocks fall, is because their valuation is very lofty. So with that revenue growth, we get $1.5 trillion in revenue in 10 years. Now, again, that might sound insane because a company like Apple today only earns under $400-ish billion in revenue. But here's the thing. Let me explain my line of thinking a little bit. I can dive into this more in a separate video, but basically this ultimately depends upon Tesla's robo-taxi business in the medium term, in this kind of 10-year time frame. If robo-taxi succeeds, it's going to be an unprecedented money printing machine. It's going to be crazy. If it doesn't succeed, Tesla might be in a bit of trouble from a valuation standpoint. Now, next, we need a profit margin. So we can find this in the same place that we found the revenue. If it's not explicitly stated, the profit margin, it's very easy to calculate. Just divide the net income by the total revenue to get the net income margin. So Tesla's most recent quarter was about 12%, but I think they actually have a good shot of increasing this over time due to operating leverage and software becoming a larger part of the business, but I'm just going to leave this at 12% for now. So that gives us $180 billion in profit per year by year 10. Next, we need to account for share dilution. I'm going to put in a rate here of 3%. Due to factors like compensation-based stock options being available for employees. But keep in mind, when companies pass the growth stage and then kind of reach maturity, dilution stops being as much of an issue, and a lot of companies actually start buying shares back. So this gives us future shares outstanding of 1.5 billion. From this, we can calculate a future earnings per share of $120. Now, to get this number, you simply take the profit and divide it by the number of shares to get earnings per share. Next, we need to assign a PE ratio, a price earnings ratio, that the company will trade for in 10 years. I'm going to put 50 here, and once again, I can already hear the yelling that this is way too high of a PE ratio in 10 years. And listen, I agree. That's a high PE ratio, but I think there's a chance it can be justified. In 10 years' time, if Tesla succeeds in their mission and vision, I think they will still be very heavily growing. I think automobiles are just the beginning. Elon has said long term, the energy side of the business will most likely grow to be as large or larger than the automobile side of the business, which is crazy because the automobile side is poised to be huge. On top of that, he said people should really be thinking about Tesla as more of a robotics company than anything else. And while you may roll your eyes at the Tesla bot now, I think Tesla has a chance of becoming an unprecedented company that just really defies common logic, like it has already done several times. And for context, Netflix took 9 years to go from a PE ratio of 318 down to 54.51, which they trade for today. And this is all while their revenue growth has tapered off. So by applying this PE ratio of 50 to our EPS of 120, we get a future stock value of 5,980. Okay, now for the super cool part of this particular model. Here we can enter in an annual return we want to receive for buying the stock. Basically what we're saying here is, if I take on the risk of owning this stock, what return would I like to achieve for that risk? For me, I'm going to put in my expectation is that Tesla will earn me an average of 20% per year over the next decade. It's a high growth, high risk, high reward investment play. So based off that, we can see this model has now spit out a stock price today that we would have to buy Tesla at in order to achieve that 20% return. So that is $966, which happens to be around where it's trading today, and that is a coincidence. But with all this being said, it is super important for me to point out that models like this are very much more an art than they are a science. The numbers and assumptions you put into this model will greatly affect what it spits out. You can make these models fit whatever particular view you have. But for me, the importance of this type of model is to just get a rough idea of what certain assumptions will look like and what a company actually has to achieve in order for an investment into it to make sense. So to me, this clearly shows that Tesla has to absolutely kill it over the next 10 years to provide this type of return. If they don't, there is a big problem here. Personally though, I'm betting that they kill it. I'm swinging for the fences on this particular investment, and to be frank with you, this is not, I wouldn't consider this to be safe. So please do not ever follow me or someone else unless you've done the work yourself and made up your own mind. This leads me perfectly into my next point. So yes, my conviction on something definitely comes from doing the work, but it also comes from knowing I've allocated the right amount of money to a particular investment. Currently, ETFs represent about 60% of my entire portfolio. I can sleep so easily at night knowing the majority of my money is invested into something that I am so confident about. I couldn't care less if the market crashes. Aside from that, the rest of my portfolio is in individual stocks and crypto, but none of these investments have more money in them than I am 100% comfortable with. If you get stressed when you see the value of a particular investment you own go down, you might be overexposed to that investment. Or you might be new to investing, and that's okay. It can take a little bit of a while to actually develop a stomach to the volatility of the markets. But the main thing I ask myself before I put money into something is, if I put this much money into it and it goes down by 50% or more, will this financially ruin me? If the answer is yes, that's a problem. If all my crypto holdings went to zero tomorrow, my life would not change. If my investment in Tesla went to zero tomorrow, my life would not change. This is because I do not have too much money in these investments based on my own personal risk tolerance. There is no one-size-fits-all approach to risk tolerance, but I think you can start by asking yourself that question. If this goes down a lot, will this hurt me financially? Or if this goes down a lot, will this really stress me out? Anyone can be confident in a bull market, but we'll see what happens if things get really ugly. Finally, I can have conviction in my investments because my own personal finances are in good shape. I have an income that exceeds my expenses. I have a 6-month emergency fund. I have no debt, no dependence, and valuable marketable skills that I can use to generate income should something happen with my career. Everyone's financial situation is going to look completely different, and that's why I made a whole video about why personal finance is called personal finance. You can watch that video in the card in the corner, and that was one of my most favorite videos I've actually made, so you should definitely check it out. I'm so happy many of you guys really loved that one. But to me, having your personal finances in good shape is basically a requirement to be a responsible investor. If you're not in a position to take risks with your money, then I think the last thing you want to be doing is investing your money in markets which carry risk. Look, flashy stuff tends to look really good and tantalizing in a bull market, but over the long term, the classic personal finance and investing wisdom tends to prevail. So with all that said, I hope you found today's video helpful. Remember to spend some time with loved ones this holiday season and to not be just watching the markets all day long. Thanks for watching and take care.